right, guys, so we're going to start. So thank you so much for joining Building Wealth for US Real Estate. So I'm super excited to bring Patrick. Patrick's helped me grow my business in the US with the proper structure. And we also have ELLIOTT MILEK. He's also one of my business partners in one of my businesses in the US, but he's also a cross-border tax specialist. He was based in Ottawa, Canada, but now he decided to go to Florida. So he'll be on board also to answer some questions at the end of the presentation. So I'll let Patrick kind of tell us a little bit about himself, and then we'll go from there and we'll ask some questions later. Welcome, Patrick.
Absolutely, my pleasure to be here. And Matthew, if you don't mind, I'll share on my end my slides, get that all set up, situated for everybody. I appreciate the introduction immensely, and always fantastic to be in front of so many folks. I was joking with Matthew earlier. Today's actually the third seminar that I've given to this seminar is the third one I've given today. So a bit scattered right now and been speaking all day, so I'm getting used to the sound of my own voice at this point. As background on my end, I'm an American-based international tax attorney. The entirety of my practice is international tax matters. I mostly at this stage work with, and it's been this way for a number of years, primarily focus on non-residents with US activities, whether from Canada, assorted jurisdictions. I work with folks all over the world as to the United States tax consequences of their American activities, be they investment activities, business activities, what have you. The US utilizes special rules that are applicable to non-residents as to their US side income tax consequences. There's a bit of background from a multinational tax perspective. Really, the area of international tax becomes most relevant at a very fundamental, at a base threshold level, when there are multiple jurisdictions that have arguments, have the nexus, let's say, to tax a particular income item. Say, for example, we have Canadian tax resident lives full-time in Canada. Let's keep it simple and go with an individual. Canadian-based individual. She spends 365 days in Canada per year. She is the owner in her individual name of assorted United States assets situs in the United States, a portion of which generate income. As to the income that is generated, the United States being what's called the source country for that income item will attempt to tax the non-resident on the income. Canada, being the country of residence, will also seek to tax the income item based on the residence of the taxpayer. Most countries around the world tax their residents on their worldwide income. The US system, as to residency, has some peculiarities to it insofar as US citizens, irrespective of their physical presence in the United States, are taxable by the United States on their worldwide income. When we look at income sourcing considerations, anybody who's more interested in that topic as to income sourcing, I wrote my first treatise with Thomson Reuters published by Thomson Reuters in October of this year, exclusively covering the income sourcing considerations. Anyone who wants more material, link to access the treatise itself, I'd be more than happy to share that via email after today's program, get all that material over to anybody who is interested. Multinational tax perspective, you're either being taxed primarily being taxed either based on your residence or being the source item of income item in a particular fact pattern. Say we have Canadian-based taxpayer, US sourced income. The United States is going to try to tax it, as well as Canada trying to tax it. When you look at how the US taxes non-residents, there are significantly narrowed scopes of taxation. Most all are intertwined with income sourcing considerations. There are certain very discrete areas under the US tax system where a non-resident establishing what we term statutorily as a US trade or business in the income tax treaty context, as we'll talk about momentarily, we reference permanent establishments within the United States. When a non-resident maintains within that permanent establishment trade or business threshold, office or fixed place of business within the country, certain discrete foreign sourced income items can be taxable by the United States. However, by and large, the United States is taxing non-residents on income sourced to the United States in real property within the United States. Special rules apply both during the life of an investment, assuming that investment is generating ordinary income, i.e. rental income. There are also special rules that are applicable upon disposition of a real property interest. We'll touch on the from an overarching surveying perspective, the applicable rules and special considerations for taxpayers who are resident of Canada. Under default statutory U.S. rules, non-residents, be they non-resident alien individuals, foreign corporations, or foreign non-grantor trust, are subject to U.S. tax on income effectively connected with the U.S. trade or business and what we call FDAP income, fixed or determinable, annual or periodic income. Important, critical to note from an overarching perspective that income tax treaties apply to reduce a source country, here the United States, ability to tax under its statutory rules. Focusing on Canada and the United States, Canada and the United States have a long-standing income tax treaty between the two countries. Income tax treaties permit qualified residents here of Canada with United States sourced income to alter the tax ramifications of the U.S. taxation of the U.S. sourced income item. If you qualify as a resident of Canada, you can utilize the Canada-U.S. income tax treaty to reduce U.S. side tax under terms covered within the treaty. The major, well, I shouldn't say the major negative, but a carve out, a massive carve out for income tax treaty relief exist in regards to real property. Source jurisdictions are particularly protective of their ability to tax income associated, whether during the life of an asset or at disposition. Source jurisdictions are particularly protective of their ability to tax that income, even if it's earned by a non-resident. When we look at things, say like dividends, royalties are another massive one under the US-Canada Treaty. Personal services, say that are performed in the case of dividends, income that's earned, royalties, income that's earned by a qualified Canadian resident is subject to significant, sometimes massive source country, US country tax relief under the Canada-US income tax treaty. Relief is much more limited in the context of real property investments, really, because when you look really from a multinational perspective, inherent with source country versus residence country tax issues are allocation and apportionment considerations for income items. Say we're generating royalties from the United States market, and we're generating those royalties through personal services that are performed in Canada. Question becomes, look, is the US the primary jurisdiction for that income item? Is Canada the primary jurisdiction for that income item? Under income tax treaties, you're receiving relief in those circumstances where there is an item that's taxable by the source country, but there's also inherent tax considerations from a residence country perspective. Source countries, whether the US or other countries, are protective of their ability to tax income associated with real property because their allocation and apportionment isn't typically as big of a concern. When you have real property cited, say to the United States, and say you're generating rental income, you're generating capital gains income on disposition of a real property interest, it's much easier to provide to operate under the idea that that income is properly cited to the United States, usually in full, properly cited to the jurisdiction that contains the real property. With that being the case, there's a significant preservation of the source jurisdiction's ability to tax that income, and resultantly, there's very limited relief under income tax treaties, be it the Canada-US treaty or other treaties, to provide relief for that income. Let's talk a bit about the background standards from a US perspective. Non-residents are taxed in the US on income effectively connected with the United States trade or business, what we call ECI income, on a net basis. Under the Canada Income Tax Treaty, this standard replaced with business profits attributable to a United States permanent establishment. It's an elevated standard. The level of elevation, particularly in the context of rural property, can be relatively light insofar as if you're meeting the ECI standard, it quite often is the case that you're also going to meet the permanent establishment standard. Relatively similar considerations associated with both. Under the US statutory rules, the trade or business concept is undefined in the code, in US Internal Revenue Code and regulations. However, the case law in the US, as well as IRS issuances as well, provides that profit-oriented activities undertaken in the United States, which are regular, continuous, and substantial, will constitute a US trade or business. FDAP income is in over-resident taxation by the United States for ordinary income items that are sourced to the United States. Includes interest, dividends, rents, royalties, remuneration, compensation. Most all ordinary income that does not meet the requirements to be taxed as effectively connected income will be taxable by the United States as FDAP income. When we have an income item, let's say rent as an example, if we have rental income that is on its face qualifies as FDAP income, but under the facts and circumstances involved, let's say hypothetically, also meets the statutory effectively connected income standard or the permanent establishment business profits associated with a permanent establishment standard under US rules. There are, in those circumstances where both categories are met, the income item is taxed as effectively connected rather than as FDAP income, and that's advantageous to non-resident taxpayers. Effectively connected income is taxable at graduated rates by the United States. Deductions, credits, expense offsets, all available for effectively connected income. You file a income tax return with the United States to report your effectively connected income, so long as you file what's called a timely return, which, depending on the type of non-resident, be it a non-resident individual or say a foreign corporation, will be somewhere between 16 to 18 months of the original due date of the US return. So long as it's filed within that period, you preserve your ability to offset expenses, credits, deductions, what have you. FDAP income, juxtaposing the taxation thereof, it's much more punitive, it's much more negative from a US perspective, insofar as it's a 30% statutory 30% gross based taxation, no offsets for deductions, credits, expenses, basis. In the case of, all right, that's a context that won't really matter from a basis perspective. You're only looking at that for capital gains, but it's a 30% rate of tax that's collected via withholding by the United States payor, the last US person with effective control over an income item payable to a non-resident that itself is subject to, that the income item is subject to United States taxation. when we're looking at the effectively connected standard and trying to determine whether a particular income item should be treated as FDAP income or as effectively connected income, assuming that the non-resident has established a United States trade or business, we look at what's called an asset use test or a material factor test. If the income results from assets used in a United States trade or business, or if the United States trade or business was a material factor in generating the income item is treated as effectively connected to the United States trade or business, or in the treaty context, treated as business profits attributable to a U.S. permanent establishment and is taxed in the more advantageous ECI context, then subject to FDAP taxation. Under income tax treaties, to cover it at the outset, because we won't spend too much time in the real property context talking about income tax treaties, the relief you're most often provided, like mentioned before, U.S. trade or business perspective, there's a substitution of business profits attributable to a U.S. permanent establishment is the substituted test for overarching taxation. It's the substitute for the statutory standard of income effectively connected to a United States trade or business. When we're looking at FDAP income, the scope of FDAP taxation isn't modified by treaties on an overarching basis. What you much more often get are reductions in tax rates in the context of things like interest, royalties, dividends, or in other circumstances, you can have a narrowing of the ability of the source country to tax. If you look at things like personal services under US sourcing rules performed in the United States are automatically subject to US tax and automatically constitute a US trade or business. If you look within income tax treaties, though, very often, if you're spending a minority of your time in the United States in a given year, and you don't have a fixed place of business in the United States, or you're not working for a US employer, very often you're able to carve out under income tax treaties the US source country taxation. Here's some more background information. We won't spend much time here given the scope of today's program, effectively connected income versus FDAP income, the rationale for the differentiated taxation. Historically, the standard has been that if you create a US trade or business and have income effectively connected there too, you're very likely to have a more significant footprint, physical footprint in the United States that gives the United States added comfort that they can collect any taxes that are owed and not paid through things like, from a Department of the Treasury perspective, liens and levies on assets. There's been a historical presumption that to create a US trade or business, you need some sort of asset footprint in the United States that the IRS can place liens, place levies, all of those things on. FDAP income very often, especially when you look at the fact that income items that fall under both the FDAP and ECI category are taxable as effectively connected income. The result very often is that FDAP largely is a non-resident's FDAP income largely, in many instances, is passive income. When you're talking about passive income, generating passive income, you don't need nearly the physical footprint in the United States. US looks at it as, hey, in these circumstances, we don't feel confident that a non-resident is going to file voluntary returns. And if a non-resident doesn't file voluntarily, that we'll have the ability to collect the ultimate tax owed, which is why a withholding system is used. This view is relatively antiquated, certainly in the context of a more digitized economy with assorted consternations and assorted options on the table to prospectively modify how source country taxation from an overarching, i.e. trade or business / permanent establishment perspective will be undertaken on a prospective basis. Looking specifically at real property now and how these rules work within the context of real property, In lieu of any elections being made, like we talked about previously, rental income is automatically folded within the FDAP category. Rental income can be classified as effectively connected to a United States trade or business if the non-resident taxpayers' activities within the United States constitute a United States trade or business. When we're looking at real property activities, there are relatively similar standards that apply to a non-resident investing in U.S. real property as would be applicable to a purely domestic U.S. taxpayer owning real property. You look at things like the level of participation in the investment by the non-resident to determine whether she or he is classified as being engaged in a U.S. trade or business, whether they're meeting the aforementioned regular, substantial, or continuous standard. Fortuitously, as to real property, and this is a narrow election that's available as relief for real property investments, non-residents can make an election, non-resident alien individuals under section 871 of the Internal Revenue Code, 871D. Foreign corporations make it under 882D, make the election under 882D. You can make an election to automatically treat rental income associated with a U.S. real property interest as being effectively connected to a U.S. trade or business. This is a massively advantageous election to make. I advise all my clients who are making U.S. real estate investments to make that are any U.S. real estate investment that is generating income during the life of the asset. I strongly advise in all circumstances to make the election because it takes the guesswork out of it. You don't have to rely on a determination that a trade or business exists under the facts and circumstances. You're looking at making a clean election that's going to allow you to have income taxed as effectively connected and thereby be able to offset expenses, take deductions, credits on the American side. Particularly when we're talking about U.S. real property interest, the ability to offset expenses is massive. I've worked with numerous clients who under the FDAP regime would be subject to significant United States taxation. But once they make the election, they have enough expenses associated with the property to, in many cases, zero out the income on a net basis and end up not owing any tax to the United States. So this is a phenomenally advantageous election on the American side, which I pretty universally advise folks to make. Here's for a prospective reference. Here are the mechanics of the election. Basically, what you do is include a statement with your U.S. tax return containing the enumerated information on the bullets. It's a straightforward form to put together. I was literally just working on one for a client about a month ago in order to make sure that we were being fully protective of their ability to be taxed in the United States on a net basis as to their real property interest. Straightforward. Excuse me, apologies, election to put together. Important to note, the election remains in effect in all subsequent years until revocation. There aren't, under the current US system, there aren't really negatives associated functionally, I would say, with putting that election in place. Prior to, and it's the next slide here, the FIRPTA provisions being enacted, there were negatives insofar as it created a more overarching prospective tax for U.S. real property interest. However, FIRPTA really folds in the prior negatives of making the election, meaning that the election now, since you're already subject to FIRPTA, irrespective of an election being made, the election in virtually all cases, I can't really think of anything where it wouldn't be, in virtually all cases, the election to treat real property ordinary income as effectively connected is a net positive. Excuse me, under the FIRPTA provisions, foreign investment in U.S. real property, these were enacted in 1980 on the American side. And this really echoes what I mentioned previously regarding source jurisdictions attempting to preserve their ability to tax income associated with real property within its borders. Section 897 of the Internal Revenue Code provides that gain from the disposition of U.S. real property interest by a non-resident is subject to tax and is automatically classified as effectively connected with a U.S. trade or business. There are two prongs to FIRPTA. 897 is the direct tax provision. There are also withholding provisions, which we'll talk about in more detail momentarily under section 1445 of the Internal Revenue Code. The withholding provisions explicitly provide that when a non-resident disposes of a U.S. real property interest, the disposition is subject to the amount realized on disposition is subject to a 15% withholding by the transferee of that income item. So it's required to be withheld at a 15% rate on the amount realized. Critical to note, though, that 15% withholding is not the tax amount that's owed. That's a backstop for the United States to ensure the tax is going to be collected. Say we have use a hypothetical, say we have $1 million property interest in the United States held by a non-resident. The basis in the property is $1.1 million. Gets disposed of, excuse me, at the $1 million number. Under the FIRPTA withholding provisions, a withholding of $150,000 is required, assuming that's the entirety of the amount realized. However, the ultimate tax owed by the non-resident to the United States after factoring in the basis will be $0, because like we talked about before, from an effectively connected perspective, you're taxing on a net basis with offsets for the assorted attributes of the property itself. FIRPTA is really illustrative, and the statutory inclusion of FIRPTA, of real property disposition income, let's say, as being effectively connected to a U.S. trade or business is really important in understanding how the U.S. tax system works as to non-residents. Like we talked about before, FDAP income is really entirely ordinary income items sourced to the United States. Effectively connected income, the other major category statutorily for U.S. taxation, is more overarching, includes both capital gains and ordinary income. When we're looking at non-residents, a non-resident who's not treated as engaged in a U.S. trade or business, there are discrete circumstances, i.e. where an individual spends over, I believe it's 182 days in the United States in a particular year, discrete circumstances where non-residents are taxable on capital gains on an overarching basis. However, in lieu of those discrete circumstances, non-residents are taxable by the United States on U.S. sourced capital gains items only if the capital gain is treated as effectively connected to a U.S. trade or business. Like we talked about before, in many factual circumstances, in lieu of, say, any election being made, quite often non-residents passively investing in U.S. real estate will not be statutorily under the case law considered to be engaged in a U.S. trade or business. This idea of preservation of source country taxation as to real property interest really is illustrated by FIRPTA, because what the United States says is, look, irrespective of your level of activity of material participation with the real property, we're automatically going to deem the disposition of this property as being effectively connected to a U.S. trade or business, thereby preserving our ability to capture tax on that item, which very well may not be the case if it is in lieu of the FIRPTA provisions. Section 897 is applicable to non-residents who are taxable by the United States. Non-resident alien individuals, foreign corporations, foreign non-grantor trusts are subject to FIRPTA as well. There are special rules that come into play in regards to partnerships. There are special withholding rules applicable to partnerships functionally if we have, say, a foreign non-resident owner of a United States disregarded entity, and US disregarded entity owns a US real property interest, that disposition is subject to FIRPTA because there's a functional look-through that applies. If we instead have a partnership that owns a US real property interest, the partnership disposing of the US real property interest will not be subject to FIRPTA, even if all of the underlying partners are non-residents. The reason for that, from an American perspective, is because there's special partnership withholding rules that are applicable that allow the US to have protection even in lieu of FIRPTA. FIRPTA doesn't need to apply in the context of partnerships because there are special partnership withholding rules that are already applicable. US real property interest, to mention for audience edification, it's not just US real property itself. Both US real property and interest in what are called United States real property holding corporations. That's any US corporation that at any time in the past 5 years owned more than 50%, had held more than 50% of its assets in US real property interests. So it's entirely possible to own stock in a US corporation and have the disposition of that stock be subject to FIRPTA. The general idea here is really that the United States doesn't want to allow non-residents to simply incorporate their real property interest, have it owned by a U.S. corporation, and be able to avoid FIRPTA mechanics, FIRPTA application. For our purposes, disposition is any transfer that would constitute a disposition for any purpose of the Internal Revenue Code and regulations. Things like gifts, exchanges are folded in here. It's given an overarching scope. Is there anything else? So we mentioned much everything else of relevance here. So let's get into withholding obligations and really fleshing out what is or isn't required there. 1445A requires the transferee, the recipient of a U.S. real property interest, to withhold a tax equal to 15% of the amount realized on the disposition. The amount realized is the sum of cash paid, fair market value of other property transferred, and any outstanding amount of a liability assumed by the transferee in association with the real property acquisition itself. There are numerous exceptions that can apply to FIRPTA withholding requirements. The one I most often utilize, and I think it's pretty universally most often utilized, that Revenue Procedure 2000-35 outlines the ability to avoid withholding through what is called a withholding certificate. Basically what you're doing, I always recommend doing it at least 90 days before the disposition of a U.S. real property interest. You basically go in, say category 2 is most often what's utilized, with a category 2 exception from withholding. Basically go to the Internal Revenue Service with documentation that, hey, listen, under our relevant facts and circumstances, say we go back to the $1 million US real property example, if the amount realized is $1 million, the withholding amount statutorily would be $150,000. But you can show documents to the Internal Revenue Service. You can provide documents evidencing that, hey, under the facts and circumstances, there is no tax owed, or if there's going to be a lesser tax than the 15% amount owed to the Internal Revenue Service, the IRS allows you to get a certificate to reduce or eliminate, whatever the facts permit, the withholding requirement by the transferee. Again, you want to request it with ample time to make sure that you can, and let's go back to that actually, that you can obtain the withholding certificate. In lieu of a withholding certificate, let's say, go back to the example, let's say the 150,000 is withheld by the transferee and paid over to the US government. What the non-resident then does, it's not like the 150,000 is lost. What's required there is to file a tax return with the United States. Like we talked about before, with effectively connected income, your pretty universally required to file a tax return with the United States. When you file the tax return with the United States, you're able to claim a refund for any over withholdings. Much better to get a withholding certificate based on timing considerations. You typically can't file a tax return, or in virtually all circumstances, or I don't know of any exception to this actually, I would say all circumstances. You cannot file a tax return to claim a refund on an over withheld amount until the year after the disposition. The IRS just doesn't allow you to file until usually January, February of the subsequent year. Given even pre-COVID, there could be significant delays in getting the refund to the non-resident. COVID has exacerbated those issues. Long-winded way of saying that there's a strong preference to obtaining a withholding certificate if you know under the facts that the Section 1445 withholding amount is going to exceed the actual amount of tax that you're going to owe to the United States. Massive area of consideration for non-resident investors in U.S. real property in particular has to do with estate and gift taxes imposed by the United States. The U.S. critical to mention at the outset, and we'll go into the rationale for this, or the not rationale for this, the ramifications and the positive ramifications of this momentarily. U.S. imposes estate and gift tax only on non-resident individuals, what we call in the estate and gift context, non-citizen, non-domiciliaries of the United States are subject to U.S. estate and gift tax only on assets situs within the United States. If we're talking about real property, any real property contained within the U.S.'s borders is subject to U.S. estate and gift tax upon a disposition, whether at death or during the lifetime of the investment. As background on how U.S. estate and gift taxes work, U.S. citizens, what we call U.S. domiciliaries for estate and gift purposes, are taxable by the United States on worldwide gratuitous transfers, whether during their lifetime or at death. However, U.S. citizens, U.S. domiciliaries receive a massive exception for 2022. It's going to be over $12 million per individual, meaning that say you have a husband and wife that are married, there's something called portability on the American side that allows the spouses to combine their exclusions and functionally pass 24 million under current law to the next generation free of estate and gift tax. What that means functionally is that the vast majority of U.S. citizens, U.S. domiciliaries are never subject to paying an actual U.S. estate or gift tax. They simply utilize their exclusion to the extent necessary. Much different ramifications for non-citizen, non-domiciled individuals. Let's call it an NCND is the terminology we typically use. NCND only subject to U.S. estate and gift tax on assets situs to the United States. Real property interest owned individually are always going to be subject statutorily to U.S. estate and gift taxation. The exclusion amount for non-citizen, non-domiciled individuals is comparatively minuscule. It's a $60,000 estate tax exclusion for non-citizen, non-domiciled individuals. The exclusion for gift tax purposes is a mere $15,000 per donee per year. When we look, let's say from an estate tax perspective, we have a Canadian-based matriarch a family matriarch who owns a $5 million Miami property as a vacation home for her extended family. Say she owns that property individually. At her passing, the estate tax on that is going to be enormous. Like mentioned at the bottom, bullet rather on the slide, you get the $60,000 exclusion after application of the $60,000 exclusion, your first $1 million of US situs assets are subject to tax graduated rates, which on aggregate adds up, assuming you have at least $1 million in the United States after the $60,000 exclusion, adds up in tax owed of $345,800. So effectively a 34.58% tax rate on your first $1 million of US situs assets subject to estate or gift taxation. After that first $1 million, everything's taxed at a flat 40% rate. So if we have a non-resident or non-citizen, non-domiciled individual who owns real property within the United States, there is a tax, use a $5 million number for the fair market value of the property. The US estate tax owed will be roughly $1.945 million. Important to note, the US estate tax doesn't work as, say, a capital gains recognition provision factoring in built-in gain basis, rather, of the property itself. You're looking at tax being assessed based on the fair market value of the property. So if it's a $5 million property with a $4 million basis, you receive a functional step up in basis on death, but you're subject to estate tax on that full $5 million amount. Let's go back to what I mentioned at the outset of the estate and gift discussion as to application of the estate tax. It's only applicable to non-resident individuals. Like mentioned previously, there are three, you can argue four, types of taxpayers, non-resident taxpayers, subject to direct US taxation. Non-resident individuals, foreign corporations, non-grantor trust, non-resident estates as well. US and Canada use the estate concept across jurisdictions. It's much less prevalent, but for US and Canada purposes, you can have estates that are created under probate testamentary rules within both jurisdictions. So a non-resident estate can also be subject to direct United States taxation on its income earned. Say hypothetically, we have Canadian individual who, the same individual we talked about before, she owns the Miami real property in her individual name. In those circumstances, she's subject to US estate tax at the aforementioned rate with the aforementioned repercussions. Let's say instead of owning it directly, she owns the asset through a Canadian corporation, through a Cayman Islands corporation, through a Mexican corporation, wherever she wants to establish a non-US corporation. Let's say she owns the stock, or she owns the real property through that corporation. She's the 100% owner of the foreign corporation. Foreign corporation then directly owns the US real property. In that case, what ends up occurring is the non-resident at her passing is treated as owning stock in a non-US corporation. That's not an asset that's cited to the United States for estate and gift tax purposes, given that it's a non-US corporation. Critically, there's also, assuming it's a valid corporation, i.e. it has a valid business purpose, if that corporation exists outside the United States, there's no look through for the underlying assets that are owned by the foreign corporation, meaning that you're not going to be subject to taxation on the underlying assets of the foreign corporation, simply by utilizing what we call a blocker in the entity structuring, in the ownership structure here. You cut off that massive US estate and gift tax exposure that would otherwise exist. Absolutely critical in all circumstances. And I see clients all the time that I work with who have pre-existing structures in place that don't incorporate that. Very often I'll find, from my perspective, clients have strong ownership structures as to the income tax consequences, but aren't nearly as protected as they should be for estate and gift tax purposes. And like we talked about with the example, the estate and gift tax exposure is very often massive compared to the US side income tax consequences. So really, I mean, if you have to choose between estate and gift protection or the income tax side, estate and gift usually is the more, it's down the line when a gratuitous transfer is made, but it usually has the more substantial impact from a US tax perspective. So it's absolutely critical to factor that in to the ownership structure. spend the last few minutes of time on my end talking about how non-residents should structure U.S. real estate investments in particular. Multitude of considerations come up. Income tax consequences within the United States, estate and gift tax consequences within the United States. Simplicity of the structure is often a critical component as well when you have non-resident investors, particularly those who are dipping their toe in the water of US investments. There's a very often a strong preference for a simplified structure to be utilized when it is both cost efficient and simple from an application, from an ongoing use perspective. A lot of times clients want to keep things simple at the outset. Then once they get comfortable with the US system, will look into more sophisticated, for lack of a better way to put it, tax planning structures to minimize both their US tax consequences and their global effective tax rates. The ownership structures that are applicable, the first option is the most straightforward, just owning a U.S. real property interest through in your individual name, or you can also own it through some sort of fiscally transparent disregarded entity. You can have things on the U.S. side like limited liability companies that by default are taxed as pass-throughs quite often. From a non-tax perspective, there are advantages to utilizing an LLC in the ownership structure, i.e. liability protection. If there are any losses, any lawsuits, things like that associated with the use of the real property, the individual owner should have, if the LLC is properly formed, properly respected, have a level of liability protection as to her individual exposures related to any real property issues. Instead, what would occur there is the harmed individual, let's say, is looking to the assets of the LLC for relief, i.e. the real property interest itself very often is the only asset that's owned by a particular LLC. Benefits here are simplicity of the structure. It really is the biggest one. The biggest detriment by far is the estate and gift tax exposure. You're also required, to the extent you're generating ordinary income, to file, like we talked about before in the ECI context. You're filing a tax return with the United States, assuming that you make the ECI election, to report income on an annual basis. Quite often I'll work with clients who want to minimize the amount of filings that they need to make with the US Department of the Treasury, with the overarching idea being, look, we don't want to have the IRS having a reason to go digging into our affairs. It's not, in most all cases, it's not that the taxpayers are doing anything nefarious at all. It's just a desire. Look, we don't want to have to deal with the hassle. We don't want to have to deal with the cost associated with the IRS digging in to what we're doing. Going to the foreign corporation concept that we talked about before, and being clear here too, both foreign corporations and foreign non-grantor trusts, as we'll discuss in a minute, can be utilized as blocker structures. Biggest benefit of utilization of the foreign corporation is the protection from estate and gift tax exposure. Corporations are taxable by the United States at a flat 21% rate, both on their capital gains income and their ordinary income. For any non-corporate taxpayer earning effectively connected income, they're taxable at graduated rates on ordinary income items up to 37%. On capital gains income items, the capital gains rate of tax is between 15 to 20% based on the amount of graduated rates there as well on the American side. If you're looking at ordinary income being generated by an investment and it's going to be significant, there can be significant appeal to utilization of a corporate structure in reducing the effective tax rate, keeping it at that flat 21% rate, rather than having graduated rates that are going to go up to 37%. A couple of detriments come into play here. It didn't go into it in much detail, but on a prior, or didn't really mention it at all actually, but on a prior slide discusses what's called the branch profits tax, which is a second level of tax by the United States applicable exclusively to foreign corporations. When you own a US real property interest or any type of US asset through a foreign corporation, there to the extent it generates ordinary income, there are two levels of taxation. First, as to the actual income that's earned. Second, the branch profits tax, which really replicates the ramifications of separately incorporating in the United States. You're being assessed a 30% tax on the earnings of the foreign corporation that are not reinvested in U.S. assets in the year the income is earned. The Canada-U.S. treaty is very friendly in removing branch profits repercussions. However, to get that removal, you have to qualify as a Canadian. The foreign corporation itself has to validly qualify as a Canadian corporation able to claim benefits under the Canada-U.S. income tax treaty. What I most often utilize in my practice as to non-resident investments in real estate in the United States is what we call the corporate structure. Rather than take the example I gave before, matriarch, Canadian-based matriarch owns foreign corporation, that with the foreign corporation under the prior hypothetical owning directly the U.S. real property, the target investment within the United States. Let's change the setup so that so the non-resident individual still owns 100% of the foreign corporation. However, under the corporate structure, the foreign corporation, instead of owning the target asset, the foreign corporation is the whole 100% owner of a separately formed U.S. corporation. That U.S. corporation then owns the target investment. There are assorted benefits associated there with there's protection from estate and gift tax exposure. There's an increased level of anonymity.
Oh, I think we lost him a little bit there. So I'll just wait for him to reconnect.
That it looks like the internet issues
Yeah.
are still ongoing, but yes, I'm just about to close up shop, so not perfect timing, but close there too. So I'll finish up really quickly while we're still here. There is what I was mentioning before. I'll step back momentarily and re-summarize what I was stating there. The corporate approach gives you the same insulation for estate and gift tax purposes as you're getting. There's an increase in under the foreign corporation direct ownership structure. There is increased anonymity as well. The largest detriment from an overarching perspective to the corporate approach is the fact that the U.S. corporation taxable both on its capital gains and its ordinary income. When we look at how foreign corporations, any type of non-resident is taxed, like we talked about before, there are gaps for capital gains income that are relevant to foreign corporations that go away once you have a domestic corporation in the ownership structure. However, here, when we're talking about real property investments, we go back to the FIRPTA provisions that we mentioned before. Those gains are automatically, any U.S. real property disposition, whether made by a U.S. corporation, foreign corporation, any type of non-resident, any taxpayer disposing of a U.S. real property interest is statutorily subject to United States taxation, making the corporate structure for real estate investments particularly friendly, because really the biggest drawback that typically applies to the corporate structure is inapplicable here. Last structure I'll mention, and then we'll close up shop, go to questions, is owning a U.S. situs income generating asset through a foreign non-grantor trust. The foreign non-grantor trust, as a separately taxable entity, functions as a blocker in the same way, assuming it's validly formed, functions as a blocker in the same exact way as occurs with a foreign corporation. You get the same exact estate and gift tax exposure. Some benefits associated with the foreign non-grantor trust structure that you're not getting from foreign corporations. No branch profits tax statutorily. You also get to utilize the long-term capital gains rates between 15 to 20% on U.S. sourced capital gains, rather than having it taxed at a flat 21% rate under the corporate income tax rules. Detriments, this sort of disposition is subject to FIRPTA because you have a non-resident owner of a U.S. real property interest. There are also special rules that come up for foreign non-grantor trust with U.S. beneficiaries. If the foreign non-grantor trust is doing what's called accumulating income, not distributing all income in the year that it's earned, there are punitive repercussions called the throwback rule. Is the primary one that comes into play for U.S. beneficiaries of foreign non-grantor trusts. You need to be careful of those rules. The ordinary income earned by the asset itself is also subject to tax at graduated rates. Foreign non-grantor trust are taxed functionally for income tax purposes as non-resident alien individuals, subject to graduated rates of tax up to 37%. So really what we focus on with real property investments in the United States, or what I focus on with real property investments in the United States, is either ownership through the corporate structure or through a foreign non-grantor trust, with really the facts and circumstances and the client's underlying factors being the most critical considerations in choosing between the two. My contact information is on this final slide here. I mentioned to Matthew earlier, and I'll mention here now, I'm in the process of, well, just late last week, I accepted an offer with a new firm. So I'm using my personal Gmail address here. I'll be starting at my new firm on December 30th. So I figured it was worth it. It makes more sense to use a personal email address rather than my current firm address, which will not be my address anymore in a couple weeks. The bottom number is my cell phone number. Like I mentioned, the vast majority of my practice at this point is working with non-residents. I work with folks literally all over the world. It means that I have to kind of sort of be available 24/7 on an ongoing basis. Something I enjoyed, something I really love. Anytime questions arise in this area, whether formally or informally, absolutely give me a shout at your pleasure. Matthew very graciously has shared, I believe, it is my LinkedIn information on there. I'm always available to talk about those issues on my end.
All right. Thank you so much, Patrick. So we got also Elliot. He's a cross-border accountant, so we can have a little bit of exchanges. But I think as a foreigner investing in the US, I think the biggest thing that we get sold as Canadian is, oh, start an LLC, get into an LLC. And it's something that maybe Elliot can talk a little bit more about it, how it's not recognized in the Canadian tax system. And it's like a flow through entity, and you're basically getting your double taxation too. So maybe Elliot, you want to maybe talk a little bit about that real quick. Won't spend too much time because it can take a lot of time to go through this, but.
Sure. Yeah, it's sorry. That's the way CRA taxes LLCs is basically as a foreign corporation as opposed to a flow-through entity like the United States does, and that's kind of where the issue arises with Canadians buying property or real property through U.S. LLCs. It was a great vehicle for U.S. citizens, and it's obviously a great vehicle. 5-6 years ago, before the CRA changed rulings on how they treated LLCs and double LPs and triple LPs essentially. So because LLCs don't have what's known as a general partner in the structure, CRA takes a position that it has the characteristics of a foreign corporation, as opposed to an actual flow-through entity or a partnership where you're required to have a general partner. So essentially, the LLC format, on the U.S. side, when you're filing a U.S. tax return, is considered a flow-through entity, and you report your income on a yearly basis from the rental property. But from a CRA perspective, you report the income when you actually take the money out of the LLC. And this disconnect between when the income is being generated in the U.S. and when the income is being recognized in Canada disallows the ability to use a foreign tax credit in Canada. So that's kind of where you kind of get the double taxation situation with an LLC format. So typically, an LP type structure would benefit a lot of Canadians because it does have the characteristics of a flow-through entity for both U.S. and CRA taxation purposes. Obviously, I don't know much on the liability aspect and how for a Canadian anyways, on how LPs are work from a CRA perspective, but from a tax perspective, CRA does recognize the limited partnership type structure as a full through entity and allows for the utilization of foreign tax credit on the Canadian side. So
Maybe let's maybe talk like the one thing every Canadian likes, the word 1031 exchange, that's like the hot topic. So maybe talk, you talked about a blocker, but how does it really work to get accepted to do a 1031 exchange? Because you got a little bit of rules and regulations to comply with the IRS, but I don't know if you guys want to just touch touch on that real quick too, because that's a hot subject in Canada. Tax-free money.
Yeah, well, now you see why I took up residency in the United States, right? So, so I mean, keep in mind, you only have to be a resident of the country for about 185 days, give or take, to take up residency in the United States, opposed to Canada. So, so you have the capacity to kind of travel a little bit, then it's certainly feasible. But essentially, CRA requires taxpayers to report their worldwide income based on CRA rules, right? So if you report a capital gain on the U.S. side and defer that capital gain using a 1031 exchange, I mean, that is a viable option for U.S. taxation purposes. But the issue arises in Canada, when you still have to report that capital gain to CRA purposes. So, if you live in a low tax jurisdiction like, Barbados or something of that sort, that would work. But if you live in Canada, where Canada has higher tax rates than the United States, essentially you're going to be paying the tax anyway. So your better option would be to pay the 15% long-term capital gains rate on the property on the U.S. side, and then pay maybe 20% in Canada and claim the FTC for 15% and only pay the additional 5% to CRA, as opposed to maybe deferring the 15% from the United States to a later date and then paying full 25% anyways to CRA. So, so you're not really getting a significant bang for your buck, unfortunately. It's certainly one of the downfalls of the Canadian tax system, and just, the United States is more favorable to real estate investors, and they're just, they're more advantageous essentially to entrepreneurs than Canada is at the moment. So.
Yeah, I would echo Elliott's sentiments in regards to 1031 exchanges wholeheartedly. And I think it's a phenomenal point. The 1031 exchange itself, the way the 1031 exchange works from an American perspective, basically you can use 1031 exchanges in limited circumstances for domestic dispositions when you're replacing the domestic property with other United States properties. In the foreign context, say you're a US-based taxpayer who's trying to utilize a 1031 exchange, any type of foreign property can be exchanged generally for any type of other foreign property. The big macro level point that's relevant, like Elliott mentioned, is that this is a tax deferral. You're not ultimately knocking the tax out. And I find very much in my practice, looking in the multinational context, be it Canada or other jurisdictions, when you're utilizing a 1031 exchange, that's just for US tax purposes. And I can't think offhand of any jurisdiction that gives deference under its statutory tax rules, certainly to 1031 exchange tax ramifications on the American side. So you can be looking at it in a situation where, hey, you're going to get a deferral of tax on the American side, but very often that ultimately is disadvantageous. Like Elliott mentions, being able to utilize foreign tax credits, things like that, those aren't going to be available in the residence jurisdiction if you're obtaining a 1031 exchange treatment. And then when you dispose of the underlying asset, you're going to be subject to tax by the United States anyway. On the 1031 exchange asset, you're ultimately subject to American taxation.
And do you guys want to touch base maybe a little bit, opportunity zone kind of comes up too. It's kind of like the same thing too for opportunity zones. I don't know if everybody knows what an opportunity zone is, but do you want to just give us a brief resume on that? Sorry.
Elliott, do you want to go first, and I'll add in from there if that works?
Yeah. Well, yeah. I mean, I deal more on the Canadian side when it comes to this, but at the end of the day, an opportunity zone is basically a program that essentially the county or the city provides real estate investors to develop that certain area, right? They allow, whether there's a deferral of property taxes or linkage of property taxes for a certain amount of time. They allow the investor to defer or even eliminate, long-term capital gains rate for a certain period of time. Again, every jurisdiction is going to be a little different depending on the needs of that location. So you're going to find a lot of these opportunity zones essentially in lower income type neighborhoods that are looking to that the city wants to develop essentially. So they provide these tax incentives to U.S. individuals that to incentivize them to develop the area. The issue obviously works again if you're a U.S. resident, you're not subject to paying that Canadian tax, because unfortunately CRA doesn't recognize these types of incentives because they're only available to Americans who reside in that area. So again, you're taxed as a Canadian on your worldwide income, and you're taxed based on CRA taxation rules. So in theory, you could defer the capital gain when you sell it in the U.S. if you have that opportunity, but you're still going to pay the capital gain on the Canadian side, in the year of sale. So.
Yeah, no, it really, the qualified opportunity zones focusing on mine entirely in the multinational context, they're not of a ton of relevance. They can be very beneficial to American taxpayers with significant built-in gain, because juxtaposing the qualified opportunity zone with the 1031 exchange, and I'm talking outside the scope of my expertise here, but my familiarity with qualified opportunity zones, it not only gives you a deferral of tax, you're knocking out a portion of the underlying capital gain. I think might be 50%. Actually, if you hold the asset, I think it's for a 10-year period, from what I recall. Yeah. So there are assorted requirements that you need to make to benefit fully from the qualified opportunity zone context, not really as relevant for multinational taxpayers in my experience. There are much better opportunities for tax savings on the American side.
So we've got another question too. Let's say you're from Canada, you want to do private lending on a property. What's the tax implication on that aspect without using a corporation? I would say not Jeremy, but Elliot, sorry.
So if you're doing it from a Canadian perspective in your personal name, you would be subject to the FDAP rules that Patrick mentioned earlier, where you're subject to about 30% withholding on the interest. Under the tax treaty, we can reduce that. So essentially, you would lend money as a Canadian to a U.S. company or a U.S. individual, and then that interest that's being received by you on a monthly basis, whatever the case may be, needs to be withheld. 30% needs to be withheld and remitted to the IRS on a yearly basis. So you have, and then that individual has two options. One, they can, in theory, pay the 30% or reduced rate under the Canada-U.S. tax treaty, and report that income on their Canadian individual return and claim an FTC, so a foreign tax credit on the Canadian side for that amount that was withheld. Or actually, I don't think they can file a U.S. return to recover that withholding. So it's basically just receive an FTC on the Canadian side for the interest received. So,
yep, from the American perspective, and I'm trying to pull up. Yeah, okay, terrific. This is trying to pull up the treaty itself. The treaty provides an article, the Canada-U.S. treaty, in Article 11.3 provides that if the beneficial owner of an interest item being a resident of Canada carries on business in the United States in which the interest arises through a permanent establishment situated therein, then the United States is able to tax that income under the treaty. Otherwise, if you utilize the treaty provisions, Article 11 here, Article 11.1 gives the overarching relief and provides that interest arising in the United States and beneficially owned by a resident of Canada may be taxed only in Canada. Phenomenal relief that's available for interest that's sourced to the United States. And under the US rules, interest payments are sourced based on the location of the payor. So just like Elliot mentioned, if you have a US payor of an interest income item that is statutorily subject to the 30% FDAP withholding rate. However, if the recipient of the income item is a qualified resident of Canada, she can utilize the Canada-US Income Tax Convention to entirely eliminate US taxation. And for edification as well, the way that you claim tax treaty benefits from a withholding perspective is by filing Form W8BEN with the withholding agent and essentially provide that, look, here we are claiming tax treaty benefits there. You file generally Form 8833 with the Internal Revenue Service to evidence the treaty claim, but with the actual withholding agent to remove the 30% withholding, you file Form W8BEN, essentially stating, hey, I'm a qualified Canadian tax resident. I'm claiming Article 11. Don't withhold at a 0% rate on all of this.
And this, there's another question here, but I know you don't really do that. How does this affect getting a visa to become a U.S. resident? But I have an immigration lawyer coming in, I think January 10th next year, to kind of talk about this, because it's a tricky thing to do it in the U.S. I think Elliot got his, was it EB2 you got?
Got an E2, yeah.
So,
Yeah.
and there's different structures that kind of help you immigrate to the US, but essentially the easiest way as a Canadian, you pay a flat fee, you invest a certain amount of money into a business, make sure you're employing a couple people. And that's what kind of Elliot did recently, because he's moved there around 3 months ago. But it's a whole different subject that will take a lot of time to go through. And then would a 1031 be allowed to avoid estate transfer tax? That's a good question. I don't even know that one.
That would be, unfortunately, is a no. You cannot, and I, there's an off chance that I'm wrong about that, but I'm virtually certain offhand that it's a no. And it really, I mean, it's absolutely a no, because the code section 1031, which is what the 1031 exchange is referencing, is an income tax provision. It doesn't work for estate and gift tax purposes. What you can utilize under, and it's important, it's a great question from an ancillary perspective of additional things to note. Canada-US income tax convention is peculiar in regards to US income tax conventions, insofar as it's the only income tax treaty that itself contains estate and gift tax relief. The US has, I believe, 14 separate, a much smaller number of estate and gift tax treaties in place when compared to income tax treaties. The Canada income tax treaty, I believe it's I want to say it's Article 30 of the treaty, contains explicit provisions providing for estate and gift tax relief, some very beneficial provisions there that you always want to check in the context of your US situs assets. However, the 1031 exchange will not work for those purposes. You're not able to avoid US estate and gift taxes by utilizing a 1031 exchange.
All right, guys, it's your last chance to ask questions before we start the networking event. And I'll send out an email with the recording, also Patrick's contact info, and also Elliott's contact info, also for the Canadian side. But I think, as a Canadian, it's very, very important to structure yourself properly to do this, because you'll be paying this for years and years to come. When I first started real estate, I'm like, I'm not too sure if it's going to work in the US. So I'm like, oh, I didn't invest the money, bought a couple properties, and I'm like, oh my God, it's going really well. And I didn't have the proper structure. That's why Patrick got involved to help me a little bit on that aspect of things. But if you do it right at the beginning and invest that extra money in doing it properly, you're going to save a lot more money in the long term.
Absolutely. I would echo the sentiments entirely. I mean, when you look from a U.S. estate and gift tax perspective alone, it's so illustrative of the exposures. And look, when you're talking about U.S. real property investments in basically all circumstances, the amount of the investment is going to have a fair market value of over $60,000. You need to be cognizant of those estate and gift rules and the massive ramifications thereof. They can be so easily avoided by putting proper planning in place. It's like Matthew mentions as well. It's best, it's not absolutely necessary by any means, but it's best to do it prior to making the investment itself, because thorny issues with built-in gain, things like that, can come up if you're trying to do it after owning the asset for a set period.
And another great question that came up, it's a good question for Patrick and Elliott here. What amount should I be prepared to pay to set it up in the US? And what are the annual costs to file? So Patrick might more come in as a tax advice on it, or structure what's the short or long-term goals, because that plays a big factor in your setup. But I'll let Elliott and Patrick answer that question better than me.
Yeah, so I mean, it's very dependent on your actual structure, on how much things are going to cost, right? So and at the end of the day, I mean, a compliance fee, typically a corporate fines, can be anywhere from, on the low end, $1,000, anywhere on, $2,500, $3,000, depending on the complexity, amount of properties you have, amount of partners in your partnership, the states you're doing business in. So, it is a wide range. Obviously, additional filings if you want bookkeeping services as well for your work. On the low end, 1,000, high end 2 to 3, but rarely do we get up that high when, unless you have a massive building that requires, cost segregation work on a regular basis, stuff like that. So, but that's typically where you're looking for like a corporate filing. But again, it's very dependent on the actual property and structure you have in place, essentially. So,
and big firms in the US we'll
Yeah.
charge a lot because we're presently doing that right now. Like Elliott's a smaller shop, so his fees are a little bit less than a big shop. But we just got quoted minimum of $4,000 US per entity to do the bookkeeping and management. But we're changing that a little bit. But it can get pretty pricey depending of the firms that you hire to do this. But the most important thing also I would say is, you know, you gotta have a good firm that understands the cross-border stuff, because that's when you get in trouble.
Yeah, and really candidly too, like I mentioned before regarding the estate and gift protection, I've seen a lot of firms that really don't know the ins and outs of this area that'll set up things. They'll look at the ECI rules, they'll look at the FDAP rules. Sometimes they'll be aware of the elections associated therewith, sometimes not. They'll put plan structures in place that are advantageous from an income tax perspective, but don't factor in at all the estate and gift tax consequences. And it's so critical to be cognizant of those. I mean, it's really the biggest savings that you can possibly have in the significant majority of circumstances. So yeah, I would unequivocally agree. You want to have people who know what they're doing in this area, providing you advice and really helping you structure your investment.
Any more questions before we start the networking, guys? All right, I guess it's over. So thank you so much, Patrick. If you want to stay, you're welcome to stay.
Yeah, you know what? I'm going to jump off, but so you know, because I saw a question in the chat to share the slides. I just sent them over to you via email. So anybody who want to share them with, whether they contact you or me, whatever works best. Cool on my end. Hope everybody has a fantastic night. Pleasure speaking with everybody. Thanks so much for your time.
Thank you again. Appreciate it. All right, everybody. Thank you so much for joining tonight.